My name is Enrique at Empower Brokerage, and I'm going to briefly cover being your own banker utilizing whole life insurance. My friend Micah wants to be his own banker, so that would be a good starting point because Micah is young. He's in his mid-20s. He's starting his career. He is insurable, meaning that he can get life insurance and qualify for it. So he has options. So someone who's young can get term insurance or whole life, but if Micah has a really good upward trend or a career path that his income is going to increase, potentially he can start with a policy that's going to build cash value. So that cash value, let's say, I'm going to throw a number out there. Let's say it's $250 a month. And Micah is, I mentioned, 25 years old. Can you imagine by itself $250 per month for the next 20, 30, 40 years? So that amount is going to grow quite significantly. Well, with the dividends paid on a whole life policy, that's going to increase the cash value on the policy based on those dividends. And because when I mention dividends, more than likely we're talking about a mutual company. So once those dividends are declared, quite frankly, the insurance company cannot take them away. In other words, they're paid into your policy and guaranteed to grow over time. So using that basic understanding, so over time, your cash value is growing up, just like Micah is growing up. So the cash reserve can be used to borrow against. Again, I'm slowing down just a little bit because I don't want to lose anybody that's listening to this. So my point again is, if you build up cash, I'm going to make up a number here, you have $50,000 in your reserve, you have a death benefit of say $125,000, so the death benefit is separate from the cash. Now, being your own banker, if you had an emergency or needed to borrow against your policy because you wanted to go buy a new scooter, wanted to go on vacation, down payment on a house, so you can take that money out in the form of a loan from the cash value. Let's put it another way. Let's say you did buy that car, you did purchase a scooter, or you went on vacation and put it on your consumer credit card. Well, now you can borrow the money against your policy, pay off the debt that you have, so the payments you were making on that scooter or that car or that credit card debt, so you freed up that cash, and that cash you can pay back to your policy. So being a mutual company, that's going to help you in the long run because as a mutual company, the dividends that are paid are going to actually indirectly be paid to your policy. So once more to repeat that. You borrow against your cash value, you pay off the debt, the consumer debt, the payments that you were mailing or emailing or auto debiting out of your account. So that cash you're going to use towards paying yourself back off or adding back to your policy. I think I've oversimplified this, but that's the basic premise of being your own banker. Now, I always use the terminology, add a couple more zeros. So if you add another zero to that $250 a month, now we're talking about $2,500. So later on, if Micah, and he's 35 years old and he's doing very well in his profession, and he decides to get another policy or increase his coverage, then once more, 15, 20, 30 years down the road, even 10 years down the road, there should be a greater increase in cash because he added one more zero to his monthly premium payment. This is not to talk about the death benefit, because the death benefit is another topic we can talk about later on. If you'd like to learn more about this, give me a call at 888-539-1633, extension 5812, or shoot me an email at etorres@empowerbrokerage.com.